Are you interested in finance? Want to understand what's happening in Belgian corporate finance? Dreaming of breaking into investment banking, M&A, or private equity? Then the Finance Show is for you. Every 2 weeks, we break down the most important corporate finance news in Belgium and around the world. We bring you expert insights, career advice, and the stories behind the deals that shape our economy. Whether you're a student looking to break in, a professional staying sharp, or simply curious about the world of finance, this is your access point to Belgian corporate finance.
Hello and welcome back to the Finance Show, the podcast that helps you stay on top of corporate finance news in Belgium and around the world. And today I'm joined by Manon. Welcome, Manon.
Happy to be here. So, what's on the menu today?
We have 3 stories. First, a major Belgian pharma deal, UCB acquiring a US biotech for up to $1.15 billion to strengthen its leadership in epilepsy. Second, GBL is back in the news, but this time to acquire a Dutch traffic management company. And finally, on the global side, a deal that mixes M&A, AI, and geopolitics. China just blocked Meta $2 billion acquisition of an AI startup called Manus.
Sounds like a lot to unpack. As always, we'll explain the technical terms along the way. So, even if you're new to corporate finance, you'll be able to follow. And we'll also drop a few interview tips for those of you preparing for IB, M&A, or PE applications.
Great, let's get into it.
So, Maxime, our first story today is a big one for Belgian pharma. UCB just announced a major US acquisition. What's going on?
Yeah, big news. On April 17th, UCB announced it's acquiring Neurona Therapeutics, a US biotech based near San Francisco. The total deal could go up to $1.15 billion. And UCB is one of Belgium's biggest pharma companies, listed on Euronext Brussels, so this matters a lot for the local market.
$1.15 billion, that's huge. How is the deal actually structured?
Good question, because it's not all paid up front. UCB pays $650 million immediately in cash, then up to $500 million more in what we call milestone payments.
Wait, what's a milestone payment exactly?
In biotech deals, you almost never pay everything at signing. The reason is the drug being acquired is often not on the market yet, and that's really important. So the buyer says, I'll pay you more, but only if the drug hits certain targets. That can be passing a clinical trial phase, getting regulatory approval, or even reaching a sales number. It protects the buyer if the drug fails, and it rewards the seller if everything goes well. It's basically a way to share the risk between both sides, the buyer and the seller.
And is this kind of structure common in M&A?
In biotech and pharma, yes, very common. In a classic M&A deal, when you buy a mature company with stable revenue, you usually pay everything upfront, in cash or stock. But in biotech, half the value is often in a drug that doesn't exist commercially yet. So you split the price. And quick tip, if you interview for healthcare M&A or pharma equity research, this is a question that comes up a lot. They will ask you something like, how would you value a biotech with no revenue? And the good answer is that you would build a risk-adjusted NPV where you discount future cash flows by the probability that the drug actually reaches the market. Phase 1 has maybe 10% chance, phase 3 60%, and that's why upfront payments are smaller than headlines numbers. The buyer is paying for expected value, but not for promised value.
Got it, that's a useful framework. And what does Neurona actually do?
Neurona is a clinical stage biotech. Their lead product is called NRTX 1001. It's a cell therapy for epilepsy, and more precisely, for a type called drug-resistant mesial temporal lobe epilepsy. Basically, patients whose epilepsy doesn't respond to existing medication.
And how does this therapy work?
It's pretty interesting. They take stem cells, engineer them into specific neurons, and inject them directly into the patient's brain. One single injection. These new cells are supposed to calm down the overactive networks that cause seizures. So instead of just managing symptoms with daily pills, you potentially repair the brain circuit itself.
That sounds futuristic, but is it actually approved?
No, and that's important. NRTX 1001 is still in phase 1-2 clinical trials, so very early stage. Quick reminder for students, drugs go through phase 1, 2, and 3 before approval. Phase 1 test safety on small group, phase 2 test if it actually works, and phase 3 is large scale on thousands of patients. Neurona is between phase 1 and 2, so still years away from markets.
So UCB is paying 650 million upfront for a drug that might never reach the market?
Exactly. That's the bet. But UCB has been in epilepsy for over 30 years. They already sell Keppra and Briviact, which are blockbuster epilepsy drug. So they know the markets, they know the doctors, they already built a network, and they know the regulatory path. The CEO Jean-Christophe Tellier said this acquisition fits their move into regenerative medicine. They are currently opening a new building in Braine-l'Alleud dedicated to the gene and cell therapies.
And how is UCB financially? Can they afford this?
Very much so. In 2025, their revenue grew 26%, reaching 7.75 billion euros. The big driver was Bimzelx, their psoriasis drug, which is selling really well. Their adjusted EBITDA was 2.64 billion, which means EBITDA margin of 34%.
Did the market react well to the announcement?
That's also an interesting part in this one. Actually, UCB stock has been under pressure. Around mid February, the stock was trading near 289 euros, an all time high, but by the end of April, it dropped to around 227. That's a 20% decline.
Why such a drop?
It's not really about Neurona deal itself, it's broader. Trump renewed his threat on pharma tariffs in the US, and there is also pressure on drug pricing through what they called most favored nation pricing. UCB even mentioned in their own press release that their guidance excludes the impact of these tariffs, because nothing is finalized yet. So the entire global pharma sector has been taking a hit, not just UCB.
But they kept their 2026 guidance.
Yes, revenue guidance is unchanged. Growth is expected between 9 and 10% at constant exchange rates. And they actually upgraded their EBITDA guidance slightly, now expecting a high single digit to mid teens growth. So management is confident even with the deal.
Last question. Who advised on the deal?
We have different advisors. Bank of America advised UCB and Centerview Partner advised Neurona. Centerview is a smaller boutique, but very well known and respected in healthcare M&A. For students looking at a boutique versus bulge bracket banks, healthcare is one of the sectors where boutiques really compete head to head with big names.
Great, very clear. On to the next one. Second story, and this one is a familiar name. We already talked about GBL in our first episode, right?
Exactly. In episode 1, we covered GBL's investment in Rainer, the eye lens manufacturer. They put 500 million euros for 45% of that company back in February. And now, just 2 months later, they're doing it again with another 500 million euro deal.
So they're really executing on something here. What's the new deal?
On April 23rd, GBL announced it's acquiring a majority stake in BUKO Group, a Dutch company specialized in temporary traffic management. GBL puts in 500 million euros of equity to take majority ownership, while the existing private equity owner, Equistone, exits, and the management team reinvests along GBL.
Wait, what does that temporary traffic management actually mean?
Basically, you see roadworks, construction sites, or big public events, someone has to set up all this signage, the cones, the safety equipment, and manage traffic flow around it. That's what you see on highway in Belgium, for example, and that's the business. Buco designs the plan, gets the permits, deploy the equipment, manages the site, and then collect everything once the work is done. They also have a growing digital side with smart traffic systems. It's not the most sexy company, but it's very essential.
And how big is BUKO?
Around 1,000 employees, operating in the Netherlands, which is their home market, plus the UK, Sweden, and Germany. Annual revenue are around 230 million euros. They were founded in 1991 as a Dutch family business, and over the last 3 years, they have made several acquisitions across Europe to scale up.
Okay, so let me understand the chain. Who actually owned BUKO before GBL?
BUKO was previously owned by Equistone Partners Europe, a private equity firm, and Equistone bought BUKO in 2023 and helped them expand internationally. Now, Equistone is exiting and selling to GBL. So GBL is buying from another financial owner.
Can you remind us what private equity actually is?
Sure, you all have heard of private equity or PE, and it's when a fund buys companies that are not listed on the stock exchange. Hence, private equity. They typically hold them for 4 to 7 years, try to grow them or improve them, and then sell them at a higher price. Usually, valuations are based on EBITDA multiples. There are two ways to increase the selling price. Either you increase the EBITDA by reducing cost and improving revenue, either you make the multiple higher, or you can even do both. The buyer can be another PE fund, a strategic buyer like a corporate, or in this case, a holding company like GBL. So Equistone did their cycle, make BUKO bigger, and now they're cashing out.
And this kind of deal, where one PE sells to another investor, has a name, right?
Yes, when a PE sells to another PE, it's called a secondary buyout. Here it's a bit different because GBL is a holding, not only a PE fund. But the logic is similar. The sector has actually seen a lot of these recently because PE funds need to return cash to their investor.
Got it. Now, coming back to GBL, why are they doing all these deals so fast?
It's part of a strategic shift. GBL has a new CEO named Johannes Huth who took over recently. He announced a new strategy in 2025, and the plan is to invest more in what they call direct private assets, meaning instead of buying minority stakes in listed company, they take majority or co-control position in private businesses.
Why the change?
Because when you control a company, you can really drive the strategy, push for growth, and create more value over time, versus owning a small piece of a listed company where you're just one shareholder among many. To prepare for this shift, GBL has been selling a lot. They sold their Umicore shares, sold part of their indirect private portfolio called GBL Capital, and sold their asset management business, Siena IM.
And what did all those sales generate?
A huge amount of about 5 billion euros in cash by the end of 2025. So now they have dry powder to deploy. The Reiner deal in February and the BUKO deal now are the first big move with that cash. So in 2 months, they already deployed 1 billion euros.
Quick question. What is GBL exactly? You mentioned it's a holding?
Yes, GBL stands for Groupe Bruxelles Lambert. It's one of the biggest holding companies on Euronext Brussels, part of the BEL 20 index. Net asset value of about 14 billion euros at the end of 2025. Behind GBL, you have the Frère and Desmarais families, two big Belgian and Canadian business families. A holding doesn't make products, it owns stake in other companies, and it values the sum of those stakes. Instead of a classic PE funds, they don't raise capital to third-party investor, they invest their own balance sheets.
In which sectors is GBL focusing?
They have identified 5 priority sectors: business services, consumer, healthcare, light industrials, and technology. BUKO falls into business services. According to GBL, this sector benefits from two structural trends. One, more regulatory compliance is needed everywhere. And two, companies are increasingly outsourcing to specialized providers. So a company like BUKO that handles safety regulation around roadworks fits both trends.
And the deal advisors?
GBL was advised by EY Parthenon for strategy and Latam and Watkins for legal. EY Parthenon is the strategy consulting arm of EY, very active in commercial due diligence work, useful to know for students looking at consulting careers in deal environments.
Cool, very clear. Next story. Last story for today, and it's a global one. Big tech, geopolitics, and AI all in one. What happened?
So this week, on April 27th, China officially ordered Meta, the parent company of Facebook, Instagram, and WhatsApp, to cancel a $2 billion acquisition. The target was a company called Manus, and the official reason given is national security.
Wait, China blocking an acquisition between two non Chinese companies? How does that work?
That's exactly what makes this story so unusual. Meta is American, Manus is officially based in Singapore, and yet Beijing is the one stopping the deal. To understand why, we need to go back to the origins of Manus.
Yes, please. What is Manus?
Manus is an AI tool, but not a chatbot like ChatGPT or Claude. It's what we call an autonomous AI agent. You give it a task and it goes off on its own to do it. It can browse the web, write code, manage files, build presentation, and do market research, for example. It launched in March 2025 and went viral very fast. Some called it the second DeepSeek moment for Chinese AI.
Who built it?
A startup called Butterfly Effect, founded in 2022 by a Chinese entrepreneur, originally based in Beijing and Wuhan, with mostly Chinese engineers. In June 2025, they moved their headquarters to Singapore, and in December 2025, Meta announced it would acquire the company for around $2 billion.
Why did Meta want it?
Because Meta is racing to catch up with OpenAI, Google, and Anthropic in AI. They have been spending massively on talent and acquisition. Manus had millions of users, over $100 million in annualized revenue, and a real product in autonomous agents, an area Meta hadn't cracked. So strategically, it made sense for Meta.
And the deal closed?
Yes, the deal was announced in December 2025 and closed earlier this year. Meta even started integrating Manus into its products. But then, in January 2026, Chinese regulators opened an investigation. They wanted to check whether the deal violated Chinese investment rules, export controls, and tech transfer regulations.
Even though the company had moved to Singapore?
Exactly. That's a key point. There is something analysts call Singapore washing. It's when Chinese tech companies relocate their headquarters to Singapore to look more international, attract foreign capital, and reduce regulatory risk. But Beijing is making clear that simply changing your address doesn't put you outside their reach. If your founders, your engineers, your IP all come from China, China still considers it as a Chinese company.
And how serious did the investigation get?
Very serious. In March, two Manus co-founders were actually banned from leaving China while authorities reviewed the deal. The case was elevated from regular economic regulator to China's National Security Commission. So this stopped being a simple antitrust review.
Quick question. What's antitrust exactly?
Antitrust law is regulation designed to prevent monopolies and protect competition. In every major countries, when two companies merge, antitrust regulators check that the deal won't reduce competition too much. China has its own version, called the Anti-Monopoly Law, from 2008, but here, antitrust is mostly the legal framing. The real reason is national security and tech protectionism.
And the conclusion?
On April 27th, the National Development and Reform Commission ruled foreign investment in Manus is prohibited and the deal must be cancelled. Beijing wants Meta to give back the funds, transfer the company's ownership back, and stop using Manus algorithm. Meta says they are preparing to comply, But how do you actually unwind an acquisition that's already closed and integrated? It's really complex.
Has China done this before?
Yes, several times. In 2018, Qualcomm tried to buy NXP, a Dutch chipmaker, for $44 billion. The deal had been approved everywhere, except China didn't give antitrust approval, and the deal collapsed. Same thing happened with Nvidia trying to buy ARM, the British chip designer. So China has a track record of using regulatory tools when strategic tech is on the table.
Why does this matter for finance students?
Two reasons. First, M&A is just not about price and synergies. Geopolitics is now a real risk factor in any cross-border deal. When you analyze a transaction, you have to assess regulatory risk in every jurisdiction, even ones where the target doesn't seem to operate. Second, this affects valuation. If a deal carries a real risk of being blocked, buyer will pay less and sellers may include reverse breakup fee to protect themselves.
What's a reverse breakup fee?
It's a fee the buyer pays to the seller if the deal falls apart for reason on the buyer's side, like failing to get regulatory approval. It can run into hundreds of millions of dollars, increasingly common in deals exposed to geopolitical risk.
And how big are these reverse breakup fees usually?
It depends on the deal size, but in tech mega deals, you typically see between 4 and 8% of the deal value. When AT&T tried to buy T-Mobile back in 2011, the reverse breakup fee was $4 billion and they actually paid it when the deal collapsed. Quick technical point that's worth knowing for interviews. When you analyze an M&A announcement, always look at three things: the headline price, the form of consideration, meaning cash versus stock, and the breakup provisions on both sides. Junior bankers who only quote the headline numbers miss half the story. The breakup structure tells you how confident each side is that the deal will actually close.
Makes sense. So back to Meta. What does this mean for them?
Short term, financial loss and reputational hits. Long term, it's a warning. Zuckerberg is reportedly planning to visit China and may seek help for the Trump administration. But it shows that in the AI race, deals involving China talents or IP are now political. The era of treating cross-border tech M&A as routine business is over.
Very clear, big topic. And that's a wrap for today. 3 deals, 3 different angles. A Belgian pharma betting on the future of cell therapy, a holding executing its new strategy with a lot of dry powder, and a global tech deal caught in the middle of US-China tensions.
What I want you to remember is this. Behind every deal, there is a logic, a structure, and a risk profile. As future finance professional, your job is to read between the lines. Why this target? Why now? Who pays what? And under what conditions? And what could make this deal fall apart? If you start watching the news with that lens, we'll be way ahead in your interviews.
Speaking of which, if you're a student in Belgium looking for finance internships or jobs, check out the Finance Show tracker on our website, thefinanceshow.com. It's an Excel file we update every week with the latest opportunities in IB, M&A, PE, and equity research across Belgium and the Benelux. Sign up with your email and you'll get it directly, plus a notification every time a new episode drops.
Thanks for listening. If you enjoyed this episode, follow us on Spotify, Apple Podcast, or Amazon Music, and share it with a friend who's always trying to break into finance. Also, don't hesitate to leave it a 5-star review. See you in 2 weeks for episode 7.
Take care, everyone!